GFPT is seeing higher animal feed sales and exports, with gross profit margin expected to expand. Hello and welcome to Inside AI Brief Setai. Today we're talking about GFPT stock. Before we begin, please don't forget to like, share, and subscribe. Okay, so today we are diving deep into GFPT, the integrated poultry player. It's a stock often seen as, pretty cyclical, but their recent Q2 numbers, that's Q2 of the Thai year 2568, they really delivered a bit of a surprise. Analysts are even talking about a potential structural breakout. We're going to stack up that performance, look at their long-term plans, their strategy, and maybe figure out what the market might be missing when it prices the stock.
Yeah, that idea of a structural breakout is, I think, key here because the Q2 results, they didn't just sort of meet expectations. They smashed the profit forecasts, which could signal that the underlying cost issues that, held GFPT back before might finally be changing. We really need to look at whether this is shifting from just cyclical luck to something more sustainable, like real operational efficiency gains.
Okay, right. Let's unpack this then, starting with those results. The big story here seems to be profit, maybe more than just volume. Q2 of 2,568 delivered a normal profit of 664 million baht. That's strong growth, up 5.7% from the previous quarter and a really solid 18.1% compared to last year. And here's the kicker, right? This number apparently blew past Yuanta's forecast by a pretty remarkable 12%.
Exactly, and what's really fascinating, I think, is why the profit jumped so much. Because total revenue was relatively flat, just a modest 1.05% year-over-year increase, hitting about 4,972 million baht. So like you said, revenue isn't the whole story here. The profit jump points straight towards the margins.
Okay, so tell us about that margin expansion. Just how significant was that increase in their gross profit margin, the GPM?
Oh, it was immense, really significant. Their GPM shot up to 16.7%. Now, to give you some context, that's a gain of almost 3 full percentage points compared to both the last quarter and the same quarter last year. For a business like this, high-volume food processing, a 16.7% GPM is, it's potentially a historically high point. It really suggests they might be changing their cost structure fundamentally, not just riding a temporary wave.
Right. So if the GPM is the main engine here, what specifically is fueling it? What's the biggest factor?
It's really the input side. The number one factor was the drop in raw material costs. We're talking specifically about their core chicken feed stuff like soybean meal. But importantly, it wasn't just cheaper inputs. There was operational discipline, too. They really got a handle on their overhead. SG&A selling, general, and admin expenses as a percentage of sales dropped quite noticeably, down to 7.0%. That was, 7.8% in Q1 and 7.9% the year before. So that shows some real internal cost-cutting discipline paying off.
Okay, so it's like two things happening at once. Cheaper feed coming in and tighter belts internally. Where did the actual business volume come from then? Which parts performed?
If you break it down by segment, the farm business was definitely the main positive driver for growth. That seems to be led by increased slaughter volume coming through their joint venture, GFN. GFN is their main processing operation, so more throughput there is good news. But that growth, it was slightly offset, kind of dampened a bit by minor decreases in their food and feed segments. Those parts were dealing with slightly softer export markets overall and also some weakness in domestic pork prices, which can have a knock-on effect.
So, okay, if the first half of 2568 was this strong, what does this start to imply for the full year, especially if analysts were maybe a bit cautious before?
Well, yeah, the profit just from the first half already makes up 63.5% of Yuanta's original full-year estimate, about 2,033 million baht. So, they're way ahead of schedule on that forecast. We think there's potentially maybe 10% upside to that full-year number. That could push the profit well over 2.2 billion baht for the year. And this is why you see analysts like Yuanta saying pretty clearly that they think the stock has bottomed out. The stability might be priced in, but maybe not this level of growth.
Okay, but the big question is always sustainability, isn't it? Can they actually maintain this kind of advantage? Let's look ahead a bit. They're not just sitting back, are they? What's GFPT's strategy to kind of lock in these margins going forward?
No, definitely not sitting still. The main focus seems to be on organic growth, sticking to their knitting, essentially, within their fully integrated chicken business. That integration controlling the feed, the farms, the processing, the final product, that's really key to shielding them somewhat from volatility. And they're backing this up with some serious capital spending capex. They're projecting investment somewhere between 1,000 to 1,200 million baht. Some sources even say maybe up to 1.5 billion.
And that capex is for something specific, isn't it? A big step up with new facilities down in Chonburi.
That's right. The headline project is the new slaughterhouse in Chonburi, That's expected to be finished sometime in the second half of 2569, maybe early 2570. And crucially, following that, about 2 years later, will be a higher value, further processing plant. So this isn't just about processing more chickens, it's about shifting towards those more complex, higher margin cooked products, especially for export. Things that fetch a better price than just basic frozen chicken.
Okay, moving towards higher value products makes sense for margins, but isn't that also a bit more specialized, maybe riskier? I mean, if those demanding markets like Japan or Europe hit a rough patch, say a recession, aren't those premium contracts often the first ones to get squeezed or renegotiated? How are they managing that risk?
That's a very sharp point, yeah. It looks like their approach is sort of two-pronged. First, they're really pushing for better export prices overall, targeting something like $4,300 to $4,400 per ton, which is up significantly from around $4,000. That helps lock in margin gains even if volumes fluctuate a bit. Second, and this is important, the domestic market provides a huge buffer for them. Historically, they rely heavily on Thailand. Something like 77–78% of revenue has been domestic. So the rebound we're seeing in Thai tourism, getting back towards those pre-pandemic levels, that acts as a kind of structural tailwind, boosting local demand from hotels, restaurants, and consumers.
That domestic anchor sounds comforting. But let's talk about what could be the really big strategic ace up their sleeve, this potential shift in sourcing feed from the US.
Ah, yes, this could be the potential game changer. The prospect of importing feed materials, specifically corn and soybean meal, directly from the US. That's a massive potential upside. If they can pull it off, reports suggest US corn could be 20–30% cheaper than what they can get on the global market right now. If they manage to execute that sourcing shift successfully, analysts estimate it could cut GFPT's overall production costs by another 10–15%. That would be a huge structural, long-term competitive advantage over pretty much all their regional competitors.
But hang on, trade negotiations, especially agricultural ones, can be notoriously slow and complex, can't they? Are there near-term targets reliant on this US deal coming through quickly?
No, not reliant, I'd say. The near-term gains we're seeing are more from managing their current inputs smartly, using forward contracts, internal production efficiencies. The US import potential is more like, well, icing on the cake.
Yeah.
But it's such a potentially large layer of icing that you absolutely have to factor into the longer-term investment view.
Okay, now let's flip to the challenges. Despite this rosy outlook, what's the biggest, most immediate operational headache they're dealing with right now?
Labor. Without a doubt, the biggest immediate risk is labor. They apparently hit a major snag when about 20% of their Cambodian workforce left due to some border issues. Just imagine trying to run complex processing lines when like 1 out of every 5 staff members suddenly isn't there. That's a huge disruption. Their fix seems sensible, though probably expensive. Ramping up overtime for the remaining staff and actively hiring replacement workers, looking towards Myanmar and Laos to try and keep the lines running at volume.
Right, that sounds tough. And what about on the commodity side? What stops another sudden spike in corn or soy prices from hitting them hard again?
Well, their vertical integration helps buffer things somewhat, but it mainly comes down to risk management and diversification. They use forward contracts to lock in prices. They diversify their sourcing, not just relying on one place, looking at Brazil and the US potential. And actually, their currency risk is also somewhat naturally hedged because they export a lot in US dollars, but they also import key feed inputs like soy and corn in US dollars. So whether the Thai baht strengthens or weakens against the dollar, it tends to largely balance out across their costs and revenues. They use forwards for any remaining imbalance, of course.
Okay, let's zoom out a bit now to the investment picture. If the company's looking this stable, showing these structural and margin improvements, how is the market actually seeing it? The analysts seem universally positive.
They really do. Yuanta just reiterated their buy rating, targeting 11.20 baht for the end of 2568. Tisco's even higher at 12.7 baht for their 2025 forecast. And Kongsri Fathanison is the most bullish of the ones we saw, targeting 13.80 baht. So yeah, strong agreement there on the upside potential.
But here's where it gets really interesting, isn't it? If all the analysts are saying buy with targets well above the current price, why is GFPT often still tagged as a laggard stock? The valuation seems, well, disconnected.
Completely. The price-to-earnings ratio right now is sitting around 5.6, maybe 5.7 times earnings. Now, compare that to the average PE for the broader food sector, which is typically hovering around 11 times, maybe higher. So GFPT is effectively trading at like half the sector's valuation multiple. The market seems to be hesitating, holding back. It probably remembers the historical volatility, the cyclical swings of the past,
people forget, or maybe don't fully appreciate, that GFPT actually stayed profitable back in 2023 when its major competitors like CPF and BTG were reporting significant losses. That really demonstrated a more resilient, structurally stable business model. But the market seems slow to give them full credit for that, possibly waiting for absolute proof that these lower input costs are here to stay, not just a temporary blip.
So the gap really boils down to market skepticism, rooted in that memory of past cycles. Is that the main reason?
I mean, that's a huge part of it, yeah. Investors are maybe treating this current performance as just another temporary upswing in the cycle. They might not fully grasp that the combination of their integration, their cost controls, and that potential U.S. import advantage could mean these improved margins are actually more sustainable, more sticky this time around. The upside is potentially massive if the market simply starts to re-rate the stock, even just partway towards the sector average PE.
And what about for investors focused more on income? Let's talk dividends. Stability is nice, but what about the yield?
Right, the current dividend yield is around 2.01%, which is okay, but not spectacular. However, Tisco is estimating that because of the strong profit recovery expected this year, the dividend yield for 2568 could jump quite significantly, perhaps to around 3.5%. Now, that starts to look like a pretty solid, attractive return, especially when you consider the balance sheet stability we talked about earlier. Lower risk, decent yield.
Okay, finally then, just a quick technical glance. Where does the stock actually sit in its recent trading range? Does the chart support this potential upside?
Yeah, quick look. As of the close on September 27th, 2568, the price is around 9.95 baht. The 52-week range is pretty key here. The low point was 8.000 and the high was 12.10 baht. So while the stock has definitely recovered nicely from those lows, it's still trading quite comfortably below its 52-week high. This confirms that those analyst targets we mentioned, 11.20 baht up towards 13.80 baht, still imply pretty significant headroom before the price even gets back to its recent peak levels. Plenty room to run, technically speaking.
That was a lot of insight packed into one deep dive. Before we wrap up, here's a final thought for you, our listener, to maybe chew on.
Yeah, think about this. GFPT is known, as we've discussed, for its relatively stable structure, and particularly its lower debt compared to big competitors. Now, given how notoriously cyclical the whole poultry industry can be, booms and busts, how much value should you, as an investor, really place on that balance sheet stability, that ability to just weather the inevitable storms? How do you weigh that against the potential for peak earnings, the chance to hit absolutely massive profits during a cyclical boom when you're choosing between different integrated food stocks? Stability versus peak potential. It's a huge question.
Finally, if you have any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you.